Welcome to today's episode of the Cover Your Assets podcast. This is your host, Billy Gwaltney, and as always, I'm excited to be with you today. In today's episode, we're going to answer the question of how to choose the right disability policy for your situation. I get this question a lot when talking with physicians across the country, helping them secure their private specialty disability coverage. The question comes up, how do I know? How do I drill down to one option for me? And so we're going to try to tackle that today. There's more to this. If you want a personal conversation, there are other podcast episodes that tie into this. It's all related. The first thing to be sure of when it comes to your own disability policy is that it's private, that it's personal. You own it. It's between you and the insurance company, which means you control it. You typically pay for it. And it has the most comprehensive definitions. It's what's called non-cancelable and guaranteed renewable, which means the insurance company can never cancel the policy. You can cancel at any time, but they cannot. They can never change the definitions, and they can never increase your rate. Okay, there can be certain guaranteed renewable contracts with one of the top companies in particular that offers an additional discount that can be significant. That might be something worth considering. Some clients like that option, and so it would be a scenario where they could potentially increase the rate for your occupation class in the future. But for most folks across the country, that would not be a consideration for you. You would just want to be sure that you have one of the top contracts that's non-cancelable and guaranteed renewable. What this means in kind of alongside of this is that your coverage that you rely on should not just be a group policy or an employer policy. Okay. By default, employer policies and group policies have to cover everyone in the group, regardless of health, usually. And what that causes is an issue called adverse selection, which is something that insurance companies run to the hills to try to avoid. They do everything they can to minimize adverse selection, having to cover everyone with the same coverage, which could potentially bring them catastrophic loss. And so anytime that is a possibility, insurance companies will water down the definitions in order to make sure that catastrophic loss is much less likely to happen. And so employer policies, even if they use the same lingo, even if they call it own occupation, how they define that is dramatically different than what we're going to talk about here and what private coverage will do if it's structured properly. So employers typically will provide some type of group coverage to their employees if you're at a hospital or health system or in some cases private practice, but you would not want to rely on that as your only form of coverage. In fact, you would want the majority of it to come from your private coverage. Unfortunately, we have clients on claim. They all get paid from their private insurance. A lot of them never see a nickel from their employer policy. And so it's literally night and day in terms of how the claims process is handled. So make sure it's private. Make sure you own it and you control it. When it comes to this type of coverage, there are only 4 insurance companies currently that offer this type of coverage that's the private, non-cancelable, and guaranteed renewable, and will contain the definitions that we're going to talk about. There are only 4, okay? And that can change over time. But if you venture outside of these 4, it gets muddy very fast from a definition standpoint. What's important to understand is that when you're choosing your policy, the name brand of the insurance company or how popular they are, whether or not you see them on TV advertisements or what have you, really doesn't matter at all at the time of claim. Okay. Of course, you want a reputable company. All right. But whether or not they are AAA rated versus AA rated, or whether or not they are just a household name will not help you at the time of claim. The only thing that's going to matter at the time of claim is what does the contract say? Okay. You can have insurance with a world-renowned insurance company and not collect at time of claim. Okay. Because of the definitions. You can conversely have an insurance company that you've never heard of that has the right definitions and be disabled and get paid. So at the end of the day, the contract is what's going to drive whether or not you get paid. The claims people are going to pull out your policy at the time of claim and read it. And that's what's going to determine whether or not you get a check. So what does it mean for a physician, a surgeon, or a non-surgeon, a pediatrician, a hospitalist, an oncologist, a thoracic surgeon, you name it? What does it mean for a physician to be disabled? That's the $1 million question. Okay. So the four contracts, the four companies that I'm talking about, I don't want to name them here because I don't want to, I can tell you that it's not a secret, but I want this podcast to, if one of these companies, if someone gets added or taken away, I don't want this podcast to be irrelevant. So it's true whether right now there are four companies, and I'll be happy to share with you which ones those are. The contract itself, the reason there are four is that these contracts that these companies have contain 3 non-negotiables to a quality disability policy. Okay. There are 3. The first one is the true specialty own occupation definition of disability. All right. And that means 2 things. One, it means that if an illness or injury prevents you from performing the material duties of your specific job, occupation, at the time of claim, then you're totally disabled. And 2, there's no penalty for income you later earn doing something different. Okay. So if you can't do your specialty, then you're disabled. You could then consult or write a book or do something related to medicine that you weren't doing before, make an unlimited income doing that, and there's no penalty to your benefit. It's the best definition you can get, and you absolutely need to have it. The second non-negotiable is what's called an enhanced residual benefit or partial benefit. What this pays for is for partial disabilities. If you can do the material duties of your specialty part-time but not full-time, and due to an illness or injury, you can't do it as often or as long or as productive as you were doing it before, and your income suffers at least a 15% loss compared to the pre-disability level, then the enhanced residual benefit or partial benefit will kick in and pay whatever that percentage loss of income you experience. They'll pay that percentage of your benefit. It's a vital must-have component of coverage. The third non-negotiable that is probably one of the most important things that most people have never heard of is called the recovery benefit. It's a long-term recovery benefit. It's attached and described in the same section of the contract as the residual or partial benefit. The recovery benefit is really important because it pays if you medically recover from a disability and go back to work. But when you go back to work, your income does not recover to what it used to be. And that happens a lot. We have clients that have collected for over a decade from a recovery benefit. They come back, they're medically cleared, they're no longer technically disabled, and they go back, they're starting from scratch. They've been out for 3 years or 5 years or even a year. It doesn't, sometimes a lot can change in a year. And their practice is evaporated. They're starting back. They don't produce as much. They get tired quicker. There are any number of things. In the days of production-driven pay for physicians, having a recovery benefit is an absolute must-have. And so it's like a 3-legged stool. Okay, that may be a corny analogy, but it's applicable. You have a 3-legged stool. If you take one of those legs away, the stool is going to be really unstable and you're probably going to fall over. All right. So you want to have the true specialty own occupation definition of disability, the enhanced residual or partial benefit, and the recovery benefit. If you have those 3, which these 4 contracts do, then you also want to have the ability to increase coverage if it's available to you without having to go back through medical screening. It's called either a future insurability option or a benefit increase rider. If that's on your policy, then you can kind of flip a switch when you become an attending or over the course of your career and increase coverage without any additional medical screening required. And with whatever trainee discount you get would be, if it's structured properly, would be contractually guaranteed to be included on everything you buy for the life of the policy. The third contractual guarantee is that the same definitions will be a part of all the increases in coverage, even if that insurance company does not offer those definitions to new policyholders. That's an important feature that oftentimes people they don't know to look for that, but you want to make sure that when you increase coverage that you're getting the same rate you're not having to redo any medical screening. You're getting the discount included, and you're getting the same definitions. 5 years from now, the insurance company you have may have changed their contract for new policyholders. You don't want to be stuck with an inferior contract or definitions or terms because they're no longer offering the robust definitions you had whenever you started. So if you structure it correctly, the future insurability option or benefit increase rider will contractually guarantee that you get those same definitions. These 4 contracts, the 4 companies that I referenced earlier, there are only 4 that offer all of those components. Okay. So you want to make sure that your coverage has all of those components. Now, once you're looking at those 4, which all of our clients look at those 4, then they start asking, well, how do I pick one? Okay. All 4, 80% of the contract terms are the same across the board. So how do I'm still at 4. I need to get down to 1. How do I do that? This is where personal choice or preference comes in. Depending on your specialty, certain insurance companies will have a longer psychiatric benefit, which pays benefits for disabilities related to addiction, depression, and anxiety. Most contracts are going to pay that for 2 years. One company offers 2 years per occurrence. Another company offers to age 65 or for the full benefit period. A couple of companies offer a buy-up option where if you pay 10% more on the rate, you can go from a 2-year psychiatric benefit to a benefit period to age 65. So we've never seen a claim go beyond 2 years for that. Obviously, that's anecdotal. It doesn't mean it couldn't. And so that's more of a personal preference. Now, keep in mind during the medical screening, if someone's ever been treated for even mild anxiety, there's a good chance they're going to exclude the psychiatric benefit. And so you just want to make sure that you would be able to access or qualify for the longer psychiatric benefit if that's important to you. But that's one kind of factor that helps people choose one over the other when it comes to picking one of the contracts. The other one is the benefit increase rider and future insurability option. Each company sets their own maximum benefit level that they will offer or insure any one physician. It's usually either $20,000 per month or $30,000 per month. In certain states, it can be $15,000 per month. It just depends. Your specialty factors into that. Where you live when you buy the coverage factors into that. And you just want to make sure that you know what that maximum cap is. And if you're $20,000 per month, so when you go to increase through the future insurability option or the benefit increase rider, there's a formula that companies use to calculate how much coverage you can buy. So if you have a $20,000 or $30,000 cap, that doesn't mean you're just going to be able to buy that much because you want to pay, because you're okay paying for that. It means that you could potentially have the ability to increase to that much if your income supports it. Okay. $20,000 per month of non-taxed benefit. This private coverage is non-taxable. So you don't pay state or federal income tax on it as long as you don't deduct the premiums. Okay. But it's most of our clients don't. I can't think of any that deduct the premiums off the top of my head. So you would not want to deduct the premiums because that's the IRS says that allows your benefit to be non-taxed. To get to $20,000 per month of non-tax benefit requires a pre-tax income of about $600,000, somewhere in that range. So if you think your income is never going to go above $600,000, then whether or not it has a $20,000 cap or $30,000 cap might not be that big a deal to you. If you are anticipating that it could go north of $600,000, or if it did, you at least want to make sure that you have the freedom to increase your coverage with a trainee discount, with no medical screening and all those components, benefits added in, then you might want to consider a company that has a $30,000 cap if that's available to you. And so that's a kind of another decision point that helps people drill down and start to find the one that might be a good fit for them. And then many, if not most of our clients can end up looking at the cost. It's okay to look down at the bottom of the spreadsheet we provide or kind of drill down and go, okay, what's the bottom line cost here? Because the cost, if you're structuring it correctly, if it's one of these 4 companies with one of these contracts that have all the non-negotiable definitions, then the rate that you're going to see, or at least the rate I'm going to show clients, is going to contain the maximum discount and based on their specialty. So there are two components that determine the rate, primarily when it comes to distinguishing between the companies. The first one is what occupation class your specialty is assigned to, based on how that company sees risk. Okay, certain companies see risk differently. Their actuaries view the risk of an ophthalmologist differently at one company than they do another company. Certain specialties are kind of the same across the board. Most, surgeons are in surgeon occupation classes. Pediatricians are usually in the better occupation classes, but there are a lot of specialties where there can be some differences in how the companies assess risk. The other component is the size of a company's discount. Discounts are driven almost entirely by a company's desire for growth, not based on the quality of their contract. Okay. So it is okay if it's structured properly. I have to caveat this to say, as long as it has the definitions, as long as it has the key components, as long as you're picking from one of these four, it is okay to pick the cheapest one. It's okay to pick a less expensive one, because generally what is causing it to be less expensive is that particular company has a larger discount, which means they're in a growth mode. And it's okay to take advantage of a company that's in a growth mode. The other component is they may have your occupation in a better classification, which means the per unit cost is lower with that company than it is with the other companies. And so if you see one of the four that has a lower rate, if it was me, and if you were my brother or sister, which is how I advise people going, here's what I would do, or here's what I would advise my family to do, is to factor in the cost. Obviously, you want to factor in the maximum benefit cap for the increase option. You might want to factor in the psychiatric benefit. There's some other perks that different companies have, but it is okay to kind of drill down and look at what the best option is for you. Okay. Then there are some customizable features to a policy, like the elimination period. Do you want it to be 90 days or 180 days, which is how long you wait from the date of a claim or disability until your first benefit check arrives? And if you want the cost of living adjustment, that costs more. That's, again, a customizable feature that you can include or not include. But ultimately, I think the cost really fits in or factors into what the coverage is going to do. And it's okay to pick one of the less expensive ones. The bottom line is you can be as picky or as surfacey as you want to be, and you'll be well served with any of the four contracts that have these non-negotiables. And I say that, the caveat I have to give is that I say that for my clients because I know what every contract has, okay? I can't speak for other brokers. Your broker does matter. Don't forget that. For making sure it does have these definitions, making sure that you understand how the discounts work and you understand how the benefit increase rider or the future insurability option work. And then also advocating for you at the time of claim. I think it's totally okay to ask your broker, hey, who's the easiest to deal with? Tell me about a claim experience you've had. How many clients do you have on claim? Do they get paid? It's okay to kind of drill down and go, what level of service can I expect when the rubber meets the road and I need help? Your broker can be as involved as you want him or her to be. And so it's important for you to make sure that the broker is involved if you want that advocacy. Because you're paying the broker. The broker gets a small percentage of the premium you pay for the life of the policy. Okay. Even if I'm on the phone with somebody and they hang up and call one of the insurance companies direct, they're going to send them to me or somebody like me because there has to be a broker. It's already built into the rate. And so it's up to you to make sure that your broker is qualified to earn that. For our clients, they get the same level of care and expertise and the quality of coverage. If they look under the hood and want to understand how the engine works and take a while to get to the point of comfort, or if they just look on a spreadsheet and tell me which one to do, you're going to get the same level of care. Make sure that your broker, that you're confident that will be the case with you. There's a lot of information. Hope you found this at least helpful to get you started. Would be happy to discuss your situation. Feel free to text me or call 704-270-2376. Again, 704-270-2376. I'm happy to discuss your situation anytime. And until we meet again, this is Billy Gwaltney. I'm grateful for your time. Thank you.